Welcome to the deep dive. Today, we're really zeroing in on something quite specific, but, super important for families managing wealth here in the UAE.
hmm
We're looking at the tax side of things for entities they use, and specifically this idea of a family foundation
Mm,
under the new corporate tax law.
that's right. We're basically working off a pretty detailed guide that came out just this May 2025. It's all about how these family foundations are taxed.
Right, and our mission really is to unpack that guide, figure out what exactly the law means by family foundation. How does the tax treatment work?
Yeah, and what does it actually mean for you, the listener, or, the beneficiaries involved? It can seem complex, but we want to cut through that.
Get to the core insights, maybe flag up some surprising bits in the guide. Let's get straight into it.
Okay, so first off, it's really, really important to understand that family foundation, it isn't some distinct legal type of entity you'd find named like that everywhere in the UAE's general laws.
Oh, okay. So, it's less a specific structure you set up and more like a label, a category for tax purposes that certain existing entities might fit into. Is that it?
Exactly, you've got it. For corporate tax, a family foundation is defined as, well, pretty much any foundation, trust, or something similar, if it meets a specific list of conditions.
Conditions laid out in the law itself.
Precisely, Article 17, Bar 1 of the corporate tax law. So the status hinges on both the legal form foundation, trust, whatever, and meeting those tax law conditions.
Got it. So it's a two-part test, kind of legal form plus tax conditions.
Correct. And interestingly, it doesn't have to be a UAE entity. The guide makes it clear foreign entities can qualify too if they meet the same criteria.
Okay, so if an entity does meet these conditions, what's the big deal tax-wise? You mentioned fiscal transparency.
Yes, that's the absolute key mechanism here. Normally, a juridical person, an entity with its own legal identity, like an incorporated foundation or trust.
Like a company, basically. It pays its own tax.
That's the default, yes, subject to corporate tax in its own right. But a family foundation, if it meets those Article 17 conditions, can apply for something different. It can ask to be treated as an unincorporated partnership.
Just for tax purposes.
Just for corporate tax purposes, exactly.
And that's what brings the fiscal transparency.
That's the magic switch. Once it's treated as an unincorporated partnership, the entity itself effectively becomes invisible for tax. It's transparent.
So the income, the expenses, assets, liabilities, it all just flows through.
It's treated as belonging directly to the beneficiaries in proportion to their share. Any tax is figured out and paid at their level, not the foundation's.
Like looking through clean glass.
Yeah.
Tax impact lands directly on the beneficiaries. That sounds, well, pretty useful.
It can be, definitely. Now, there's a slight twist for trusts or similar setups that don't have that separate legal personality. Unincorporated trusts, the guide calls them.
Okay, maybe like a simple contractual trust.
Could be. Those ones are treated as unincorporated partnerships by default. Automatically transparent, no application needed for that part.
Ah, okay.
But, and this is important, they still need to meet those same Article 17.1 family foundation conditions if you want them to have the actual status of a family foundation.
Why does the status matter if they're already transparent anyway?
Well, that really comes into play when you look at structures with multiple layers, which we'll get to. If a transparent family foundation owns other companies below it, those lower companies might need the top one to be a designated family foundation to get their own transparency.
Okay, right, that connects the dots. So let's nail this down. What are those exact conditions in Article 17.1? The ones any foundation or trust needs to meet to be a family foundation and get this transparent treatment. This feels central.
It absolutely is. There are basically 5 key hurdles. First, the beneficiary condition. The entity has to be set up and run for the benefit of identified or identifiable natural persons or public benefit entities or, a mix of both.
Okay, identified versus identifiable. Quick clarification.
Sure. Identified means named individuals. Identifiable means a defined group, like my descendants or employees of X company. And importantly, this can include people not even born yet.
Right, and public benefit entities.
Mm-hmm.
Do they have to be on that special qualifying public benefit entity list?
Good question. No, not necessarily. The guide says it's the broader sense. Charities, nonprofits, community groups. A qualifying PBE would count, of course, but it's not limited to just them for this condition.
Interesting. Any limits on how many beneficiaries? Or if they have to be related?
Nope. The guide's quite specific. No minimums, no maximums, no rules about relationships, and they can benefit directly or indirectly through another transparent entity.
Okay, clear. Condition number 2.
The principal activity condition, its main job, its main activity, has to be about receiving, holding, investing, managing, or dispersing funds or assets, and crucially related to savings or investment.
So like managing a stock portfolio, holding investment properties, that kind of thing.
Exactly. Activities aimed at growing wealth or generating income from assets, plus distributing funds to beneficiaries or charities, and paying its own running costs like manager fees.
Makes sense.
Yeah.
Condition 3. This one seemed, well, pretty critical based on the guide's examples.
It is. It really is. The no business activity condition. This says the entity must not do anything that would count as a business or business activity if, say, the founder or a beneficiary did it directly as an individual.
Okay, now this is where it gets really interesting, right? Because individuals in the UAE aren't taxed on all their income. How does that link up?
That's the crucial connection. The law carves out specific income types for individuals that aren't from a business: wages, personal investment income, and real estate investment income.
So wait, does that mean the family foundation can do things that would generate personal investment or real estate investment income if a beneficiary did them directly?
Yes, precisely. It can undertake those activities. What it absolutely cannot do is engage in an activity that, if an individual did it, would be considered a commercial business, likely needing a license.
Okay, let's use example 1 from the guide, the J Foundation. It rents out homes,
Yeah.
but it also runs a motel.
Right. So the renting out residential units part, assuming no special commercial license is needed for that scale, that activity, if done by the beneficiaries directly, is likely real estate investment income for them. So that activity is fine for the foundation. It meets the condition for that bit.
But the motel,
Yeah.
that feels different, like a proper business.
It is. Running a motel typically is a commercial activity, would need a license if an individual did it. Because the J Foundation runs that motel, it fails the no business activity condition completely. The guide's firm. Any such disallowed activity disqualifies it entirely from being a family foundation and getting transparency.
Wow. So you have to look at each activity through that what if an individual did it lens. It's a key filter. Okay, condition 4.
Simpler one, the no tax avoidance condition. The main reason for setting it up or running it can't be just to dodge corporate tax.
Fair enough. But actually applying for the transparent status, that's okay. That's not seen as avoidance.
Correct. The guide explicitly says using this unincorporated partnership application, which enables the transparency, is not itself considered a tax avoidance purpose. It's using the intended mechanism.
Good. That's important. And the last one, number 5.
This one's conditional, the distribution condition. It only kicks in if the foundation has any public benefit entities as beneficiaries.
So if it only benefits natural persons, you ignore this one.
Exactly. But if there is a public entity beneficiary, then one of two things must be true. Condition A, the income flowing to that public benefit entity wouldn't be taxable income for them anyway if they got it directly.
How might that happen?
Maybe all the income is exempt income under other rules, or perhaps the public benefit entity is one of those qualifying public benefit entities, so it's exempt from tax anyway.
Okay. And if condition A isn't met, so some income would be taxable for that beneficiary.
Then condition B applies. Any income share that would be taxable for that specific public benefit entity beneficiary must actually be distributed to them within 6 months after the end of the family foundation's tax period.
Whoa, okay. A hard deadline for distributing taxable income, but only to those specific beneficiaries. Let's use example 2. Foundation benefits people and a non-qualifying public benefit entity. It sells shares, makes a gain, but participation exemption doesn't apply.
Right. So no participation exemption means the gain would be taxable income for that public benefit entity if received directly. Condition A fails. So to keep its transparent status, the foundation must pay out that public benefit entity's share of that specific gain within 6 months of the tax year end when the gain happened. Doesn't necessarily have to distribute the individual shares on that same timeline for this rule.
That really clarifies the when and what of that condition. Okay, great. We've got the conditions. You mentioned earlier foreign entities can play too. How does that work, especially if they own, say, UAE property?
Yeah, a foreign entity can definitely be a family foundation if it meets all those Article 17(1) conditions we just went through. Now, the interesting part is, even if that foreign entity has a nexus here, like owning UAE real estate makes income here, it would normally be a taxable person in the UAE on that income.
Non-resident taxable person, right?
Exactly. But even so, it could still apply for the fiscally transparent family foundation treatment if it meets all the conditions.
So even if it's technically taxable here due to its UAE assets, it might be able to switch to transparent status if it qualifies as a family foundation. That's quite something.
It is. Example 3 shows this well. Foreign foundation owns UAE property, beneficiaries are a UAE family, and a foreign charity. The foundation is a taxable person here because of the property income needs to register. But if it meets the conditions, applies, and gets approved for transparency,
Then the foundation itself isn't taxed here.
correct, it flows through. For the UAE family members, their slice of the property income is real estate investment income, not taxed for them personally. For the foreign charity, though, its share is subject to UAE corporate tax because it's seen as a non-resident earning income from UAE property.
And example 4, similar idea. GCC foundation, GCC family, UAE property.
Very similar outcome. Foundation X from another GCC state owns UAE property, creating a nexus. It's a taxable person, must register. But if it meets the family foundation conditions and gets transparency approval, the income passes through. The GCC family's share is real estate investment income, not taxed personally under UAE CT. Foundation X itself isn't taxed in the UAE on that income because it's transparent.
Fascinating. Now, this gets even more interesting when you have layers, right? Those multi-tier structures. What if a family foundation owns, say, a company underneath it? Can that company also become transparent?
Yes, absolutely. There's a specific rule for this in the guide. A juridical person, like an LLC subsidiary, can apply to be treated as an unincorporated partnership. So, transparent if it's wholly owned and controlled by a family foundation, or by another entity that's already transparent for UAE tax.
Wholly owned and controlled. Does that mean 100% directly?
Yes, 100% ownership. It can be direct ownership or indirect, but if it's indirect, it has to be through an unbroken chain of other entities that are all fiscally transparent under UAE corporate tax law.
And do these lower-level companies need to meet those same Article 17(1) conditions themselves?
Mostly, yes. They need to satisfy the conditions about principal activity, no business activity, and no tax avoidance purpose. The beneficiary condition, though, is kind of met by proxy if the ultimate family foundation at the top meets it. That covers the subsidiaries below for that specific point.
So they still can't be, like, running an actual business down there.
Absolutely not. Any commercial business activity anywhere in the chain disqualifies the entities below it from this transparency treatment. And crucially, all the conditions have to be met continuously all year by every entity in the chain. One slip-up breaks the chain for everyone below.
Let's use example 6. Simple case. Family foundation N owns LLC subsidiary A, which owns LLC subsidiary B. Both A and B just hold real estate.
Okay, so FFN applies for transparency first. Let's assume it gets it. Then, subsidiary A, it's wholly owned by transparent FFN. Its activity is real estate holding, which fits. If it meets the other conditions, no business, etc., it can apply for transparency. If approved, its income flows through FFN.
And subsidiary B under A.
B is wholly owned by A. If A is approved as transparent, the chain from N through A to B is unbroken. B's activity is also real estate. If B meets the other conditions, it can apply too. If everyone gets approved, all the income from A and B flows up transparently and is treated as real estate investment income for the family members at the top. No corporate tax at the entity levels.
Okay, but example 7 shows a different setup. Family foundation C, a trust but treated as juridical here, owns 80% of company D. A family member owns the other 20% directly.
Right. Here's the problem. Company D is not wholly owned by Family Foundation C. Because of that 20% direct family ownership, it fails the wholly owned and controlled test needed for a subsidiary to get transparency in a multi-tier setup.
So company D stays taxable. It can't become transparent.
Correct. Company D remains a regular taxable person, pays corporate tax on its profits. Any income Company D passes up to FFC, that 80% share, would then flow through the transparent FFC to the beneficiaries. That income would likely be personal investment income for them, so still potentially not taxed at their level. And the dividends the family member gets directly on their 20% could also be personal investment income.
Example 8, an unincorporated trust. Trust E at the top. It owns company F 100% and company G 90% directly, 10% via F.
Okay, Trust E is an unincorporated trust, so it's transparent by default, assuming it meets the family foundation conditions. It wholly owns company F, so F can apply for transparency. It also wholly owns company G, 90% direct plus 10% via wholly owned F equals 100% control, so G can also apply. If F and G get approved, their income, real estate from F, personal investment from G, flows up transparently to the beneficiaries, treated as REPI income for them. The guide also adds that the trustee's fees are taxable for the trustee.
Example 9. Two different family foundations, FF1 and FF2, jointly own an SPV. Let's call it J8020.
Even if FF1 and FF2 are transparent, SPJ is owned by two separate entities. It's not wholly owned by one family foundation or transparent entity. So SPVJ fails the test for subsidiary transparency. It cannot apply and remains a normal taxable person. Distributions from J to FF1 and FF2 would then flow through them as personal investment income to the ultimate beneficiaries.
And example 10 wraps this up. Multi-tier FFK, juridical, owned foreign company L. Both get transparency. But FFK has family and a public entity beneficiary.
Right. This brings back that distribution condition for FFK.
Yeah.
If Company L pays a dividend up to FFK, and that dividend would be taxable income for the public benefit entity beneficiary, say participation exemption doesn't apply and it's not a qualifying PBE.
Then FFK has to act.
Yes. FFK must distribute that public benefit entity's share of that specific dividend income to the public benefit entity within 6 months of the end of FFK's tax year.
And if they miss that deadline, what happens then?
Failure to distribute means they fail a condition, and the consequence is severe. Both FFK and Company L lose their transparency status retroactively right back to the start of the tax period when the failure occurred. They become taxable from day one of that period.
Oof. Okay, that retroactive loss of status.
Yeah.
That's a huge risk. Really highlights needing to stay on top of compliance. So, okay, let's pull back a bit. When this all works, when the foundation and maybe companies below it are transparent, what's the bottom line for the beneficiaries? Who pays the tax, if any?
Well, as we've said, the tax burden shifts. The beneficiaries are treated, for tax purposes, as if they did the activities or own the assets themselves. Tax is figured out at their level.
And the key takeaway for most individual natural person beneficiaries?
Generally, good news. Their share of income flowing up, if it's classified as personal investment income or real estate investment income under the rules for individuals, is not subject to corporate tax for them personally. That's often the main goal.
But what about the public benefit entity beneficiaries?
If it's a qualifying public benefit entity, it's exempt anyway, so no tax. If it's a public benefit entity that is a taxable person, then its share of the income and expenses from the transparent structure gets included in its own corporate tax calculation.
What about things like the participation exemption on dividends or share gains? Does the family foundation claim that, or the beneficiary?
Great question, and the guide is specific. The participation exemption rules apply at the level of the beneficiary, not the transparent foundation. Example 11 makes this clear. Foundation S is transparent. Beneficiaries are people P and Q, and public benefit entity R. Foundation S holds shares in Company T.
Yeah.
If Company T pays a dividend or Foundation S sells the shares, you look at beneficiary R. Does R meet the conditions to claim participation exemption on its share of that income? If yes, R's share is exempt for R. If no, R's share is taxable income for R. And that then triggers the 6-month distribution rule from Foundation S to R for that specific taxable share.
Wow, so the foundation managers need to know how the income might be taxed for each public benefit beneficiary to manage distributions and stay compliant. That adds complexity.
It definitely does. The guide also mentions how deductions flow through and that payments for services to beneficiaries are treated differently than distributions, and potential foreign tax credits for taxable beneficiaries.
Okay, rules, structures, outcomes. How do you actually make this happen? What are the practical compliance steps?
Right, the nuts and bolts. Step 1, registration. The juridical persons applying for transparency, the foundation or subsidiaries, they have to register for corporate tax first. Even those unincorporated trusts that are transparent by default need to register.
What about beneficiaries?
Natural person beneficiaries usually don't need to register just for this unless they have other taxable businesses. But public benefit entities that are taxable persons, yes, they need to register.
Okay, registered. Then the application for the unincorporated partnership treatment.
That's next for the juridical entities wanting transparency. Apply to the FTA. Normally before the end of the tax year you want it for, though there's that helpful catch-up deadline. Apply by December 31st, 2025, and it can potentially cover earlier periods ending up to March 31st, 2025. You need beneficiary info, confirm conditions are met.
Foreign entities applying.
Similar process. They'll likely need documents from home to prove they meet the UAE's conditions.
And in those multi-tier setups, can the top foundation apply for everyone?
Yes, the guide says the top transparent entity can apply on behalf of the wholly owned ones below it. Or each can apply individually, but approval depends on the one above being transparent.
And is it a one-time thing or ongoing?
Ongoing. Annual confirmation. Every year, the approved transparent juridical entities have to confirm they still meet all the conditions, usually due 9 months after the tax year ends. Again, there's a special DIC 31 2025 deadline mentioned for early periods. This can also be filed centrally or individually.
And finally, that point you made earlier. What if, down the line, they fail a condition after being approved?
Yeah, as we discussed, the consequence is quite harsh. If any approved entity fails any condition during the year, it loses its transparent status immediately, and it's treated as a regular taxable person right back to the beginning of the tax year when the failure happened.
Ouch. That retroactive switch is definitely something to watch out for. Puts a real emphasis on getting it right and keeping it right.
It really does. And remember, in a multi-tier chain, if one entity fails, it breaks the chain. Everyone below it loses their transparency status under these rules too.
We've certainly covered a lot of ground here. Unpacked the definition, the crucial conditions, how transparency works, looked at foreign entities, multi-tiers with lots of examples, the impact on beneficiaries, and the compliance steps, registration, application, annual checks. The aim was really to give you, the listener, a clear path through this specific part of the tax law based on the guide.
And it's a useful guide, definitely sheds light on a complex area.
It really does. But, the guide itself says it's just guidance, not legally binding advice. Everyone's situation is different. Which kind of leads to a final thought, doesn't it? How much this all relies on very precise legal definitions. What exactly is personal investment versus a business? And needing to meet all conditions all the time. Does this just underscore how vital, tailored, professional advice is, even when you have detailed guidance like this? Getting it wrong seems like it could be quite costly.
That's a very important question for anyone considering these structures. Definitely something to think about.